Hello everyone, welcome again to another lecture. Today we're going to cover specifically value areas. We're going to cover to some extent balances. This is something that I've wanted to cover for a while, so we're going to dive into it today, and we're going to look at it in tandem with longer term profiles, so weekly profiles, monthly profiles, but we're not going to do it all in one go. We're going to do it in bite size as always. Thanks again for being here as always. So we're going to kick off the lecture today. I'm not going to give you too much of a mini chat like I always do. I'm going to go straight into things so we can cover a lot today, as much as we can reasonably cover within the hour. I tend to do these. Okay, so let's start with something that we're familiar with, which is cable. Right, so I've covered the pound a lot. For me, it's an asset that I trade a lot and I understand very well. It is where I do my day-to-day business, so I fully grasp a lot of what's happening with it. So I'm not saying that you have to essentially trade a pound. I like it. I think it's a great asset. If you're an FX trader, I think it really offers you a lot of things. It offers you a bit more volatility than some of the other currency asset classes. It's traded in the major centers, which conforms with my time trifecta. So essentially, if you're trading the pound, you've got the London Open, you've got the US Opens, i.e. New York, Chicago, you've got to at some extent Asia as well, which I also like to trade, right? And again, if you ever decide that I'm going to be a long-term follow as an individual for you, then at some point I have no doubt you probably check out my private members area, and if you do, you'll be able to find out their particular strategy that I use. And I always use the profile, but a particular strategy on the profile that I use in order to achieve the things that I've achieved and will continue to achieve, no doubt. Yeah, I know. I can get a little bit overconfident. Especially because I've been doing it for a long time. I'm assuming if you've been doing it for a year or two, your confidence level is going to be a little lower. And I always hear this really weird situation where people say, "Oh, overconfidence always kills you in the market." Blah blah blah. Is to some extent, I think what everyone's trying to say is that you're going to make mistakes. You get confident that you're really good at something. One day you're going to mess up, and for a lot of people, it's apparently eating humble pie. But I think I've never, and I'm going to make this analogy now, some people are going to correct me or say I'm wrong or something, but ultimately, a doctor would never say that, I'm just a humble doctor. They're not going to do that. They're going to say, look, I'm a really good doctor, I know what I'm doing, or I'm a really good lawyer, I know what I'm doing. And I'm pretty sure I can get that tumor out of your brain, or I'm pretty sure I can do this. So there is going to be an element of confidence once you are confident in what you're doing. I think a lot of the traders who talk a lot about humble pie and whatever, they're never really confident in what they're doing. Even if they're highly successful, they're always on edge. It could be a personality thing. It could be that they just never found a way to gain confidence where they do something. I have no idea what happened there. My system's just flickered for a second. Anyway, take a look at a later stage. So they never really get to the stage, of course, where they were able to build their own confidence sufficiently to say that I'm pretty good at what I do. Again, I can't tell you exactly where that comes from. I mean, I personally have done a lot of psychological work on myself. I really believe in Carl Jung's theories and ideas around, personality, human beings, and I bring a lot of that into my own psychological work with trading. I often believe that you have to integrate your shadow. I think older cultures have often said that you got to kill your shadow. I say you got to integrate your shadow, of course, so that you are confident with who you are, and that's what you bring to the game. We all have shadow selves. Our shadows are simply just the things that were repressed in childhood that were considered socially unacceptable, or essentially your parents thought was socially unacceptable to them. And some of those could be, core personality traits that you possess that make you who you are, but unfortunately they got suppressed. Those will come out in your trading. Some of the professional work I did on this allowed me to understand this, and eventually you come to realize that you need to bring those sides of you that you think people might not like. You've got to bring it into trading. And some of the most successful traders that I see, a lot of them have done this. They've been able to reach out to a side of them that essentially was locked away, and they will express it in different ways. But because I've done the work, I understand exactly what's going on for a lot of them, even if they don't know what's going on for themselves, right? So it just depends on the kind of investment or time investment you've put into yourself when it comes to trading. And I think that I've done that over the years. When I mentor people, I try and help them in that. And anyone who's been on my mentorship and my one-on-one mentorships would explain and tell you essentially that they had this experience with me, where I also look to unpack what's holding them back psychologically. And most of the time, they will go on to start seeing marked improvements because they were able to handle or deal with the psychological side of things. I understand it's not everyone's cup of tea, but I personally think that that's something that everyone needs to work on themselves, mentally at least. So, back to what I was saying with the pound. Okay, so this is a weekly profile of the pound. I think if you've been following the lectures, and if you haven't looked at the past lectures, please go back and watch them over and over and over again so that it cements itself, and then come back to where we are. Don't start from here. You're just denying yourself a good opportunity to learn something that you didn't know before, and you're going to affect your own learning curve on what you can actually do with this. And you're going to go away in a couple of months, you're still going to be unsuccessful, and you're going to wonder why. If you've come in here looking for just clicking around and the usual, you're bored on your phone or something like that, you're not going to enjoy this, so you might as well leave. This is going to be a horrible experience for you, because you're not going to want to do this. You're going to think it's a boring YouTube video. It's not what you're used to. So yeah, it might be a good idea for you to just walk away, because you're not going to get that here. But if you're here for a learning experience and you want to be able to understand this so you can use it at some future point to better your own life and the life of your family and people you love and care for, then essentially I know you would stick through and do exactly what I'm telling you. Because if you do exactly what I'm telling you, I'm pretty sure you are going to be successful as a trader down the line. Just have to stick with it. If you don't, then for my part, I've done my best. I trade for a living, so I'm quite happy with what I am. It's now all about you, so it's not about me. So as much as you love, hate the videos that I do, this is about you. Right, moving on. So again, weekly profile of the pound. Now, what we're going to talk about specifically today is value areas. Right, so what's a value area? So essentially it's where 70% of all the distribution is going to rest. Right, so it's the fairest prices that the market's going to deliver. Right, and this little box here that pops up is essentially that value area. So at the top of the box, you'll see it says value high, VA low. Right, so this is the lowest fairest price. This is the highest fairest price. So typically, traders want to trade from the lowest fairest price to the highest fairest price if they're bullish. It's also what we call a value trade. Every time we cycle the previous value, so I'm going to look on the left side of the chart, something I don't often do, but just for context, I'm going to split this profile. And what you can see is that we opened this profile of the week, Monday, and then we traded through value. Right? So if you notice, we got a nice little development, and that went to value high, and then we failed, right? And we came back into value, and we traded down through value again, right? This is a good day for a value trade. Now, there's something that you need to know with value trades. They are high probability in that they occur 70% of the time. With any distribution, you are going to get more value trades than you get an expanded market. If you get a consistently expanded market, then you're probably dealing with a major global type issue where maybe high inflation is driving a specific asset and causing it to no longer trade value. Most of the time, assets would return to some kind of value. You'd hear this described by some people as mean reversions. You hear it talked about in various different ways, but really what it is the market has reached the highest, fairest price and is now coming back essentially to the lowest, fairest price, where it will attract bids or buyers. It's pretty easy to understand. It's not particularly complicated. So that's all it is. A value trade is something quite simple. It's a 70% probability trade, as we call it in the industry. It's a high probability setup. So if you see the market trading value, right, then it's a good idea to get in that direction. And you normally know that because the market will start to settle or pause at the lower half of value, and you get this creeping rally, right? And it tells you you're probably set up for a value trade. The other thing is, of course, they don't happen all the time, and sometimes they're not even going to completely go through value. But there's a higher probability, especially in an asset class that consolidates a lot, that you're going to see a hell of a lot more value trades. Right, so this here is an example of a value trade, right? So if you're trading, if you think that we're going on the upside for a value trade, then of course we want to essentially find bid prices that we can attack the market at. So for example, we went A, B, C, D, E period up on the value trade. We might have started to think at C period that this is going to be a value trade. Then we're going to probably look for bids on the lower third of the D period rotation, right? So that's where we're going to want to be buyers. And our stop losses are going to want to be below the low of the week in this case, or below the low of the prior week, which was down here. There's a lot of protection. But since it's a value trade, we can apply an element of risk management today. So, we don't have to get so worried that we're going to get a lot of liquidity sweeping, that we're essentially going to get tapped out at the low of the week. So I'll go for the low of the prior week, right, since the market's held at that level. And then I'll say, well, look, that's a 42 pip stop loss. And then I'm going to go for a value pip trade, which is about 86 pips. That is perfectly achievable, and it's a 2-to-1 trade. However, it's going to span across the week. It's just not enough directional volatility in this asset class on a week for us to be able to do any more. So this is a one-shot trade for the week. Now, I'm sure at this point, you should be asking yourself, for 86 pips in a week? Damn, that is not what I was expecting. I'm expecting to make 86 pips in a day. Well, first and foremost, that's not gonna happen unless you are a very in and out type scalper, which is a much more high risk. I don't trade like that, so I can't really teach you anything valuable with that kind of trading. If that's the kind of trading you want to do, where you're trading every minute you're taking a trade and you take 20 trades in a day, then I'm not your guy. I'm not going to be able to help you with that. In my opinion, you should have no more than 2-3 trades max in a day, even if you're trading a completely different strategy, a different idea. If you're on a day trade, you shouldn't really have that more than 2 to 3 days. Trades. If you have more than 2 to 3 trades, you're exposing yourself to considerable drawdown risk, right? And there's probably a higher likelihood you're going to blow the account. So if you're already that kind of trader that's already saying to themselves that that sounds like me, I trade 4 or 5 trades, 6 trades sometimes in a day, that is exactly me, then you're probably not a profitable trader, or you're struggling and you're wondering why. That is partly the reason why. And the point about these lectures is, to be honest, is to be able to help you guys get over the line. And I can guarantee you that's one of the reasons why you're losing money, is because you're trading too much. So a lot of you would be thinking 86 pips is not enough on a week. And to be honest, I'm inclined to agree with you, but I'm not going to. And I'm not going to because it's about size. If you know that you take a value trade every week, for example, and I'm not saying you should take a value trade every week now, so you just go install the profile and then start taking value trades. That's not what I'm saying. What I'm saying is that if you did take value trades in a week and that's the only thing that you did, then potentially you're going to have the opportunity to risk 42 pips and 86 pips. Or if mathematically speaking, if it was a one lot position, that's $420, and 86 pips is $860. That's $860 in a week, right? Now, I'm a big advocate, and that's because it's the way I approach trading. Some people approach trading with the idea that they want to buy a Ferrari down the line. You know, they want a holiday home in the Hamptons, right? They approach trading from the perspective that they want a Swiss chalet. That is not how I approach trading, right? Because I'm a little bit more realistic. Even as a money manager, you know, where you have funds under management, your priority would be to your clients, right? So there's a limit to which you can shaft them. Of course, if you've gotten to the level where you're managing, you know, billions, then yeah, probably, you know, with a 1.5% fee annually on billions, you're probably going to be able to get your Hamptons home. You're probably going to be able to buy a Ferrari. But the vast majority of people in that position are not going to have that. A lot of them tend to be a lot older. They tend to be less ostentatious in that way. So reality is reality. They're not going to be investing that kind of money into those things. They consume in a different way. You know, there are a lot of people who make a lot of profits from like ventures that are aligned with their trading, and some of them feel inclined to purchase a lot more ostentatious goods in order to kind of say to their community that, hey, I am very successful at this. And, you know, this brings clicks, it brings attention. Attention is now the currency of the world. Is if you can grab people's attention, then that's what it's all about. But for myself here, that's not how I approach trading, and I'm not going to attempt to do that for you guys at any point. I'm not going to attempt to be telling you that I've got a Ferrari or that's what you should be aiming for. What I say is that traders should be aiming for a payday, right? Because imagine a lot of you have come from a job, right? And I believe if you're going to be a good trader down the line, you've got to trade full time. Because if you spend more time on your day job, you're going to be really good at your day job, but you're going to be very bad at trading because you spend less time on trading. It's really simple. At some point, you have to spend less time on your day job, which eventually leads to no day job, and more time on trading. If you can't do that, then you're always going to be treading water, right? You're never going to get to that level where you feel confident enough to be a trader. A lot of people listening to this, some of you have a good amount of saving, you've got everything you need to start, you're just scared. And that's okay. The point of doing these lectures is to show you that there's nothing to be scared about. There's systems, strategies, there's things available to you that weren't around to people who started trading 15, 20 years ago that are around today. If you were a trader 15, 20 years ago, you know what I'm talking about. You know it was a struggle, right? Because there was nothing. There wasn't TradingView. There wasn't, you know, TPO charts like this were just near enough inaccessible. There wasn't even the market, the execution level to say that, you know, I mean, regulation NMS brought in HFT in 2007. You know, so really and truly, we only started to see a lot of this liquidity pop into the market at those times. So there's just not been the bandwidth for the early life traders where you genuinely had to spend 2 or 3 years trying to get your head around these markets because the accessibility was really slimmed down. The technology was almost virtually non-existent. Right? In the retail world, almost everybody traded with MT4. There was just no other platform. A couple of brokers tried to do bespoke platforms that were broken. They were literally broken. They just didn't work the way they were supposed to. The cost of trading was so high that sometimes you question your sanity as to why you're doing this. There was also a lot of economic fundamentals going on at those times that also made trading quite difficult. Bottom line is that today it's not the case. This market is hot. It's ripe for anyone who wants to learn to trade today. It's just so easy to do it. And honestly speaking, if I was learning to trade today, it would have been so much easier. I think I would have learned everything in about 6 months. I would have become proficient trader in about 6 months, just because I know the time it took me to be able to develop my skill set starting at the times that I started, right? I was pre-2009. Yeah, So back in your mind, just know that there's everything for you at this point in time. Anyway, back to the value trade. So the value trade is simply that, is we come from the lowest fairest price to the highest fairest price, and vice versa, we can do that. So going back to that point there of, is 86 pips enough? Of course it is, more than enough. You make yourself a wage first, you pay yourself, right? Once you can do that, because like I said, a lot of you come in from jobs that you got a paycheck. So if you can initially pay yourself, then it's a good start, because now you can build on that. If you can't pay yourself, there's no way you're going to get that Ferrari, right? So you've got to focus on being realistic initially. Again, if you're starting a trading account, and again, a lot of this lecture is going to be targeting people who probably have a more substantial trading account. If you've got a very small trading account, this is not going to work for you. And I'm going to tell you exactly why this is going to be a genuine struggle. And you're probably going to and this is why a lot of traders don't end up sticking with it. It's really sad when you see a lot of bigger traders with 200-300k accounts saying that, I only trade the daily chart. And you know what's funny is a lot of these guys have been built up by their communities who've, given them, bought courses from them, done mentorships with them. So they've been able to raise a lot of capital from these individuals. So now they have larger trading accounts. And they don't want to take the intraday risk. They don't want to find themselves in a position where they're trying to seek alpha. So what they want to do is they want to essentially take the safe route, right? The easy route to analyze. But the problem with that is that, if you've got a $3,000 stop loss and you're looking to make, 6k in a week, that's perfect, right? But in order to have a $3,000 stop loss, you're probably looking at a 50k account upwards, right? And that's a lot of risk appetite as well. But with my skill level, for example, that's not a problem. But for other people's skill level who are new, that will be a problem to stomach the risk of a 3k stop loss. So you're not going to find many new traders sitting on a trade with a 3k stop loss on a week, right? On a long-term position. It's because, again, if that trade doesn't go your way, and you're going to see examples of that here, the first thing that's going to happen is you're going to panic on the first loss that you take, because now you think, I'm down 3k, I need to wait for the next setup, which might not be for another week or two, or a couple of days at the very minimum, because you're on a weekly profile. So you're going to see setups that occur, like this value trade, for example. It occurred in the week, we got 1 and then we got 2. This is a perfect day, and then that was it, right? Opportunity's gone. There's nothing else now to do. So the opportunity for you to come in and out is greatly reduced. So you trade less by default, and it takes a longer time for you to rack up the reps or the occurrences, so you can even start to quantify your own strategy. So there's a lot of disadvantages to trading a longer time frame. You need more capital, you get less reps, and you essentially have to be more experienced if you're going to start trading longer frames, because getting less reps mean you understand your own strategy less, and it means low confidence. But it's essential to kind of see how the weekly frames work, so when you do get to that level, you're going to be able to feel confident if you wanted to say, I want to step back from the intraday world and I want to get into the longer time frame world, right? And it also helps you analyze where the intraday's going, right? That's important too, because, right, you want to kind of have a feel for it. And a lot of the volatility in these assets, they come at certain points. You get an explosion and then everything just contracts again. So the weekly profile helps you understand where you're likely to see those explosions and where you're really going to see a big one, right? But as you can see, despite an 86 pip move, top to bottom, it wasn't completely directional. It went up initially, came down, and then continued higher. So it takes a lot of trust and a lot of understanding, a lot of foresight to kind of want to be in these kind of trades. And essentially it does mean that you already need to come into a degree of confidence. So it's always it irks me sometimes when I see a trader talking about, trade a longer time frame, you lose money because you trade a short time frame. It's a load of bollocks, right? It's just a load of bollocks. It's not because of that. If you're losing money on a shorter time frame, it's because you don't know what you're doing. You're not suited to that time frame because you don't know enough about it. I'm not going to start trading 1 minute charts if I don't know enough. I don't have a system, an idea, a strategy to trade 1 minute charts. There are a lot of people who's highly successful trading under 1 minute charts. I know how you could do that. You can't do it in spread markets like FX, for example. I'm fairly certain you can, but in futures you might be able to do it. And I'm sure there are people doing it and they're making a mint. But in my case, I'm not doing it, so that I'm not making a mint from trading 1 minute charts. Not going to happen, right? What I'm showing you here is what I know and what I understand and what's worked for me, and I'm hoping that you can take some of this for yourself. All right, moving on. So we've seen an example of a value chart here, right? And if we go back, we see similar the next day. Of course, we're in a consolidating market. So again, you can see we opened at the lower side of value and we start to move higher. Again, you'd look for the lower half of the rotation, in this case B rotation, and then you look to get in here, stops again below the low, right? It's about 39 pips. Again, you're looking for value. If you can assess the range of the asset, and we'll talk about that soon, then you can start to deduce that, well, I've got 40 pips of risk, I'm looking for 80 pips there, which is about what looked at the time like an offer stack, right? So you might want to push your luck, right? So about sort of 80, 81, 82, you're way above value at this point. You want to start thinking about getting out of the trade. Again, you can see as we pull back in on the week, you can see in P period we're back in value. So again, another perfect opportunity to get short as we break out the low of O period, stops above the high, 50 ticks, we're looking to go through value, which is about 100, and that puts us down here, and then we want to cover the trade. All right. So for a couple of weeks, you've had some really good runs. But now let's go back one step and take a look at this week. This week, we open at the higher value and then break out and get into an excess territory. Well, the difference with these kind of trades is when you see them, you're looking more for a fade back, right? Because we're already in excess, right? So if we buy in excess, we have to be highly confident that the market is going to keep going higher, right? So if you remember going back to our concepts around liquidity, what I did say is that when you go above a weekly high, we're going to initially run into stops. And we're going to run those stops, in this case, buy stops, right? And we're going to take a lot of the traders out with buy stops. And then we're going to probably see a pullback, right? Is because when we run stops, we run into that liquidity, we bring in all of that hidden liquidity back in, right? And that's all stop losses and stop orders, ones that only the broker knows where they are. Well, whoever the counterparty is, they're the only people who know where your stops are, because those are orders you've told them to place at market if a specific event occurs. In this case, a specific price event. So that's what we told them. So they're the only ones who know. And if they can find a counterparty for those orders, they're going to tell that counterparty that that's where you want to put your sell price, right? Because if you want to go short, that's exactly where you want to go short, because we're going to find a hell of a lot of buyers at that price. So once that liquidity comes into the market, the reaction tells you everything you need to know. We run those stops, we bring those hidden orders alive, and then the market goes lower, right? So you want to look for those kind of scenarios because they're more likely to occur. So looking a fade becomes that critical thing that we want to see. And so it becomes a slightly easier predictor for an intraday. In this case, we would have done what we call the dynamic value trade, where we will trade our own value area. So in this case, a lot of the value would have built up most likely around this area. So when we started to trade back in, we would be likely trading the dynamic value, right? So the value on the day. Again, we see a similar example here where the price opens in excess territory, where again we're way above value, so we've left the value area down here, and then we keep extending. Again, we expect to the highs, we're going to see a run on stops. In this case, we didn't quite see that. We go up and then we continue the excess. This is where the trade goes wrong. If you're looking for a fade opportunity, you're not going to be able to see one. We didn't even get that into dynamic value. We literally just continued higher. We had a small pullback and then continued. There's not a lot you can do about that. There are times when the market's just going to go parabolic. Not a lot you can do about it. It's what it is. You just have to look and see where the next opportunity is going to be, because obviously a move like this is probably indicating it's coming from a place that is just completely different. Last one, we'll take a look at, again, you can see the market opens excess low, right? So we are at we're outside of value now. Again, we expect us to have a mean reversion. So we open, initially we go in, right? We hit an offer stack, we struggle. We might think, okay, this market's ready to go higher. Again, if you went into a trade like this, it's a lot more risk. It's 80, 90 ticks. I'd wait for the market to settle, in my opinion. But again, if you did go, you're a novice, you probably didn't get your move, right? It broke down against you. That is totally okay, because we are going to lose some trades. We're not going to get everything. And what happened, we traded into this value. So I'm just going to now run you straight into the concept of previous value. Now, the market is always going to reference value, right? So the one thing we need to understand is that these previous value areas need to be marked out as points of interest. So when we was trading here, there was more of a likelihood, because we're mid-value, that we were going to go to value low, and this would have been a good entry point to start with at a lower value. However, if we made the error and we broke down, we should expect that we should see some interesting buying at these levels. We just need to see confirmation, which we had in this J period run, where we had a tell that this would have been a good area to buy, and we're likely to get that roll on dynamic value, but we're also likely to take this value here. So again, if we look at the return, right, and we look at this value, and we look at this value, you can see in V period we were up there. So again, it's giving us an indication that we're going to go through value, and that's the trade we would look for. We get confirmation of that when we close up on W period. You can look for bids round about here, stops lower W or V period, and we look to go through value. Of course, the lower W is more ideal. We can get out of the trade about here, and then we're done. Very short trade against the week. Not complicated at all. So in this case, we're just looking for a trade back through value, right? Especially when we've perceived we've hit a low, we've gone through this value, and we're coming now to take out this. So these areas of value would start to become really good reference points. Hopefully, we start to understand the importance of the value areas, right? So I've done the left side of the chart. So I'm just going to go back to the right side of the chart. I really feel like when I'm on the left side of the chart, I'm like, I need to go back to the current price action. I'm wedded with current price action, because what's in front of you now, there's no greater benchmark. Right? So let's look at this week. Again, opened value low, started to build. Good opportunity was, as soon as we set up in B period, we could look to get long, stops under A period. Again, if we're going for a value trade, not enough risk reward there for me personally, but again, it's a value trade setup, right? If you see it, you get on as early as you can. In this case, we had a strong A period, so I would have sat here 30 pips, that's more like it, 75, right? So you kind of also want to gauge what your potential reward's going to be on a value trade, and that should also guide you for your potential get into the trade. If I've already traveled a third of value, then I'm already under the impression that this is a value trade. And if we're setting up for a value trade, I want to be able to sit close enough to the lower third of the 8 period run, but from what I can see, even if I was long here, I would have had a pretty good 37 pips. I would be close enough to get in what I needed to get. It's about 75 pips to the close of the C period. If I pushed it a little bit, it would have been a struggle, right? So you can see we've already done value for the week. Any breaks now would take us to take the liquidity at a high, so you have to be highly confident if you're going to start trading from, say, mid-value, right? Which will be the fair, the midpoint of the value area, which is kind of, the middle of fair prices. I kind of don't want to be in that point. But again, we have a bid stack here, so that might draw some confidence. But if this stack fails, which it can do because it's pretty high, we won't see any relief till this bid stack. So it's a high risk trade to take, right? It's a lot of room for the market to move if we do lose the J period low. So these are all things that we want to consider if we're going to start trading from these midpoints. But in reality, if we're trading from the lowest fairest price to the highest fairest price, we're in effect doing a value trade, right? Again, when we reach that top and we struggled, a lot of people will be positioning to see if we can come all the way down. I wouldn't like this setup because of the bid stack, so I'll never realistically start to trade into a bid stack. I'd rather trade after the bid stack is broken, right? So this is just a little nuance that you can factor in, is that please don't go short into a bid stack because it can rip your face off, right? Anyone who's short here now is in a very high risk position. There's a really good chance that they're going to have their face ripped off and it's going to go up. So you don't want to do that. So if you can't, so genuinely speaking, if you're coming into the trade and it's in a bid stack, step away. You want to catch it. If you're up here and you're going a value high, you're thinking, I'll trade into the bid stack and I'll put in some other kind of risk management, maybe break even a trade, take some money off the table, whatever it is that suits your fancy. We'll talk a little bit more about, the best ways to manage money. All right, so we like the way this setup going to the high. That was your play. That was your really good play. So I think of the market in a very strategic way, that I'm looking at it strategically, what's going to be most viable for my position. If I was taking this trade, I can see that we've got a bid stack down here, a lot of protection, right? I can sit under value low, under essentially what could end up being the low of the week, right? And there's a lot of potential if I'm going to go long. Now, I'm also aware that we closed into what could have been described as an offer stack. This is unusual, right? We shouldn't be closing solidly into it and then doing positive rotation, which means that a B period is rotating above the A period. We shouldn't be seeing that. What we should be seeing is a lot more tail action and maybe closes under the offer stack from the very open, or B period opens and then comes back and then spends more time trading the open or the opening price. Then I'll be a little bit more like, ooh, this thing could go lower and I don't necessarily want to short into this bid stack here. So I'll probably wait to see if we can break through it and then I can find a better entry, for example, right? So I like to be strategic about what I'm doing. I also prefer to trade from, so if I wanted to go short, I'd really look to do that here, to be honest. So within the top third, the highest, fairest prices, that will be the best advantage. And if I wanted to go long, that's the best advantage. It's a little bit easier to do this when we're coming from already a significant low on the week, right? So when we look at a collection of these weekly profiles, it's easier to make the trades if we're down here on the week, right? So we're coming out of a value low. A good example will be this. If we're hitting these levels, it's a lot easier to make the decision to go long, right? Because it's immediately telling you we've hit the value low here. We're going to blast through and trade the length of this value here at the very least. That's 100 pips for a week. Great, easily detect. But what do you do when we start to open? Even this is easy to detect. What happens when we do this? We need to pick another point. And that's where we start being strategic. Here we see a run on liquidity. So the K period low pushes us to the bid stack. look for a reaction, and then we buy the bid stack and then trade the dynamic value, because you don't have a choice, because you don't know if you're going to get a value trade. So you have to be more strategic and dynamic when you're approaching trading in general, right? And especially when you're dealing with these longer frames where the one decision you make is going to pay you that week or not. And you might have to look at maybe a series of 4 trades across a month to say that you have to be 50-50 at 1 to 2 to be, to feel like you've made a decent profit that month. So there's a lot of pressure because you got just a few shots in the chamber before you're out of bullets. You can't argue your way through it. It's just not possible, right? You've got to be able to, you've got to be accurate, put it that way. So for me, I always say it takes more experience, right? So these calls are a lot easier to make, right? These ones here and these ones here. But what about these ones? They get much harder to make when the market consolidates. Point in case. Now this is no different for every market. Let's take a look at the NASDAQ, for example. Again, pretty easy when we see moves like this. Very difficult when we start to open in excess and get a little bit parabolic. So how do we tackle this in the best possible way, right? So we've seen a value trade, what that consists of. We understand the basic concept of trading value, but what's the best way to attack it? So now is when we put some of those additional overlays. These are 4-hour rotations, so it's going to feel like you're trading a 4-hour chart. So we're going to look for opportunities within the rotations to make up what we think this market's going to do. So let's start with where we first started to see that when we got that huge drop in the NASDAQ. We all remember that crazy move, right? It sent a lot of us off guard. How did that move start? So I'm going to split this rotation. Again, I'm going to go to the left side of the chart. Don't worry, I've already spoken about the NASDAQ on the right side of the chart. I'll go, before we close the lectures, I'll go to the daily profiles and I'll show you exactly. I did say this, that the NASDAQ looked like it was going to go higher from just looking at those profiles. So I don't need to talk about the right side of the chart. I'm not here giving you trading signals. What I'm doing is trying to help you understand this whole process. Split this up. So let's see where the move started initially on the week, right? And it should start to become apparent. Right? I'm going to split this profile. Actually, no, I'll leave that one the way it is. So we have a bid stack down here. Right, so we know that this is going to be a strong level to overcome, right? And then we open and we trade around a little bit. So first and foremost, we open, close lower, consolidate, and then we do a small run on the liquidity at the start of the week, right? And we close an F. Most people, that starts to look like an opportunity to short. If we go up, we can see we traded lower, rebounded, hit that level in M. That was a good shorting opportunity, right? So you're going to sit at the highs. I think that's, what are we? It's about 20 points. And then we go down for about 32 points and then we have a rebound. What happens here? Again, we trade the liquidity that has built up at these lows. Now, because we have a bid stack here, like I said, I would have been unlikely to short into the bid stack. And if I did, I would have probably started a cover as we drove into the liquidity low here. That would have been my goal. And then I'd want to get out. So there just wasn't enough in it. But this move here was a little bit more decisive. We can see the open, Q period here, where we close and open. And then we can see the close here of our period before we open S. So this is a massive tail, right? Which indicates that we've drawn on the sell stops at the bottom here, just before we hit the bid stack. This becomes a perfect long, right? So I want to get long here, and then my stops will go beneath the low, or I want them here. Now, if I have them under the bid stack, then I'm going to be looking for a much bigger move. If I have them here, then I can look for a much shorter move because that's all I had at risk. Entirely up to you. Now, the beauty about trading indices, right? This is the advantage of trading an index. Whether you're trading it spot as futures, this is a spot index, right? This is not a futures index, right? It's a spot index. The beauty of this is that because of the asymmetric nature of the NASDAQ, it could keep going higher. So it allows us to build into a position for much longer and capture a much bigger move with much lower risk. So often you'd hear futures traders talking about, they're trying to build into a move, buy every few handles lower, blah, blah, blah. It's what they're doing is just managing themselves into a much bigger position for a much bigger run, whilst all the while taking off the risk on the original position. This only works for certain assets, and if you try this on any other asset class, you're going to get destroyed, right? That's why a lot of traders don't want to trade currencies, because they want these parabolic moves that are going to last months, if possible, if you catch a decent bull run. But the problem is it only happens in assets that get highly inflated, and that's the indices because they're associated with stocks, and stocks normally do really well in times of high inflation, where effectively there's a lot of money being printed, or expectations of money being printed, right? So we tend to see all these parabolic moves coming out of indices. So they're great asset classes to trade if you're going to build in positions into them. They're not bad at all, right? So again, we can see that development, right? And if we're positioned already, so let me just delete one of these. So if we're positioned here with risk here, when I close this profile, right, this is where we are, by the way. It's just a shift in the chart, right? We have a really good position because our stops, let's roll this over, are going to be down here, right? So our position would look a lot like this, right? Because we looked at the S period. That's what it's going to look like. Roll it up tight, right? And that's what our position is going to look like. And this is where we closed, right? And we got this normal distribution. So immediately, my mind's telling me, if we've already seen a run on sell stops, so we already know that we're in a good position, and then the profile is now telling us that we've got a normal distribution. And let me explain normal distribution, because someone asked in the comments a question about, in one of the lectures, about states. So we have balance, which is this normal distribution. We have imbalance, which is best described as this, right? Trend week. And then we have test, which is in some cases best described as this. So somewhat like a normal variation. So there are different profile types, and I'm going to come into that in a different lecture. Don't want to attack it all today, but we either have a normal distribution, we have typically a neutral, but to be honest, a neutral and a normal are kind of almost the same thing. You've got a normal variation, which is a distribution that can look a little bit like a normal distribution, but it isn't. It's slightly elongated, so it's a normal variation. And then we've got a trend week, which is the most popular. We all want to be on those, right? So trend weeks tend to be strong open, strong close, very long value area, right? So they look like this. And every time we see a trend week, that value area can be very difficult to trade through. So it acts as a level of support. If we have a trend week like this, we can assume that there's going to be decent support if the value area is elongated. And it doesn't matter the direction. So this is an example of what looks like a lot more short term. I say what looks like because the larger entities are building positions in normal distributions, right, in preparation for a big drive. But it will typically, we say that 80% of the money in the market is short-term money, 20% long-term money, because the 20% long-term money is eating up all the 80% short-term money, right? So it's an 80-20 split between long-term and short-term money. A normal variation is a 60-40. And a trend week is an 80-20. So we typically say the market goes from imbalance, which would be a trend week, to balance, which would be a normal variation or normal distribution. And that's what you see here. We go from imbalance to balance to balance. Or you can say we go from imbalance to test to balance, right? Because what happens after an imbalance is we continue to test the upside to see the market reaction, and then we often pause or balance to accumulate to go higher or distribute, go lower. So we go from these states, from imbalance to test to balance, or imbalance to balance to test, or it could be any different combination, but we're going to see one of these states in the market at any given week. The downside is that we don't know what state we're going to achieve. Are we going to get a balanced state this week? Are we going to get a test state this week? We just don't know. And in indices, the benchmark would have been the initial balance, right? That will be able to tell you typically what to expect. And I won't get into that right now, but I promise you I'll come back to that again. But the balance will be able to tell you. And often, if the balance can't tell you, then you effectively can't predict what it's going to be. So you have to just position in a way that you can attack this, right, without having to think so much about what kind of state or what kind of day you're going to get. So when we see a normal distribution, we know what follows is effectively going to be a huge drive. All right, so sorry guys, I have no idea. Someone's out on the highways with a megaphone and it's literally just flooding the entire house, but never mind. Anyway, moving on. So again, open, close, we can see normal distribution. If we open higher in the following week, then we're going to get a big expansion most likely. And that's what happened. So we opened, we had a gap up, we split this profile, then it was just a straight continuation run to the upside, and then we start to see some weakness. So we can tie those other concepts in, right? And if we look at what happened after that, we got up, we hit W period, and then we had a draw. Oops, because we're long, right? We're not particularly worried. We had a draw on the liquidity here. So what can we do? Well, we cover our trade initially. So when we hit that W period high and we consolidated, we cover the trade. Because now our expectation is, if we're going to go higher, we would need to see this price drop at least. Oops. Let's pull this out a little bit. Close this. Right, so we'd at least need to see the market drop back to the bid stack here or value low. Right, and I'll mark this out for you to see. Or we could potentially come and fill the gap and retest this level. But because we know with indices, because of the way equities work, we are unlikely to see these kind of parabolic drops, especially after we've built up a position to go higher. The track tends to be almost always higher. So what are we looking for? Well, it's really simple. We just want to see a draw, a decent draw on liquidity at the value low, right? Because that for me would be the target, is can we get down to this level, and then I want to be a buyer. Of course, I could try and be a buyer here, right? But again, I'm well aware it's not the most efficient price. We did get a draw on the liquidity at this point. So you'll be forgiven for getting long, but then you'd want to hide your stops as far as possible, right? In my opinion, that would be here. So when you take that into account, this could have been potentially a losing trade if you'd gone with that option, but you would have had another opportunity to recover that. If you have an existing long position, then what you could do is incrementally add. So let's say you had 10 contracts long on the NASDAQ here. You could add, say, another 3 contracts at this point, which allows you to expand your risk a little bit more because you've already got a gain and you've added 3 contracts more at this point. So if it came down a little and rebounded, right? So again, we can see we came down, and if we split this profile, let's see if that was a draw on liquidity. and it was right here. Right, so we can see we ran the sell stops here. So for me, on the close of C period, slight bid down, last ticket of the week, we can get long for a move into it. So again, we can keep those stops. Again, what can we do? We can add maybe another 3 contracts at this price, right? And then that allows us to expand our risk a little bit more, right? But again, just sitting here would be perfect, and then we can go for a much bigger run. So the concept is not any different to trading the intraday, right? But what you're finding in each of these scenarios is that you're able to, well, you're going to need more, you're going to need to put more risk to work, because again, opportunities are coming, but they're coming on a week-to-week basis. So you need to be able to plan for that financially, right? Because you're not going to have as much at work. Indices are more effective for these longer terms. We've identified that based on the way the index is behaving, is that we can get more parabolic runs, which allows us to build into positions at good times, right? And this can allow us to really expand our game, right? So this kind of trading might feel a little easier because we're getting these assets that are guided by inflation. On the flip side, when we looked at currency, we can see that we were much better off with a lot more value trades and targeting these key levels if we're going to make the trades on the week. So especially bid stacks, they've been useful value areas, and also some of these key previous value, that means value going back a few days or a few weeks. Perfect, I hope this makes sense. It's been a lecture a lot centered around value, especially value around a week and longer cycles. So hopefully you've learned a lot today. Go back, rewatch the video. I know it's a lot to unpack, especially if you're new to profiles. If you need access to the TPO, I say this almost on every video because I know some of you are going to join these lectures despite what I say at lesson 7 and expect to learn something. But if you want access to the TPO, I have it available. DM me in my Discord server, and then I'll send you the details. And if you want to acquire it, then you can let me know. TPO is not easy to get hold of. To have it on something like MetaTrader where you can have free data and you can actually do some of the trades that we're talking about, it's a godsend. Right now, it's just not easy to find. So if you want access to it, let me know. Everywhere else, you're going to pay a ton of money to have this continuously, and it's not going to be useful to you if you don't have it. Everything you're learning here is pointless if you can't apply it. Awesome stuff, guys. Till the next lecture, adios.